Hello and welcome to another Invest with Clarity podcast with Mark Pearson. Today we are going through 10 of the top 20 stock market predictions for the roaring 2020s. Now, Mark, we did this a couple of years ago. We did this last year, but we're in uncharted waters here, brother. This is something that we've never really experienced post-pandemic, craziness in the world of politics. I don't know, an asteroid's going to hit the world soon. So what are we talking? How are we even looking at predictions this year?
Well, what a time to be alive, as my nephew likes to say. We have been doing these predictions actually for 8 years. And I don't generally like to brag, but I'm going to brag on you just for a minute and basically tell you that for the 8 years we've done our prediction, of course, we've been 100% in every prediction for the last 8 years.
Okay, brother, but you're doubling down this time because last year we only did 10. We're doing 20 this year.
That's right. We're feeling bullish. It's the roaring 20s. We're feeling bullish.
All right.
And after such a super fantastic year for investing in 2020, why not kick off 2021, the roaring 20s, with 20 predictions?
Okay, so here's what I'm thinking. I'm thinking finally, after years of trying to catch you in something where I stump you or something along those lines, now that you've stuck your neck out for 20 predictions, I think that these are going to be the next few podcasts I'm going to get you.
I wish you the best of luck, Biggie.
All right, man, let's go ahead. Let's dive right into this. So where do we begin?
Yeah, so let me begin by saying, for those who don't know these predictions, do you remember a couple years ago when I put these predictions out and a guy sent me an email and said that and basically made my case for these predictions? Yeah. As you know, people are, and we've done a white paper on this called Addiction to Prediction. People are addicted to predictions. They at the end of each year, investors and money managers and economists and everyone else likes to prognosticate, postulate, and speculate. And we feel we got to do the same thing. But of course, with investing with clarity, we have a little bit different spin on our predictions. So as you know, it is now the roaring 2020s, the roaring 20s. And in an effort to keep our streak going, let's begin with prediction number one. Investors will continue to see the predictions on where the S&P 500 will end in 2021, just like they did, of course, Matt, in 2020. And investors will be misled with the potential consequences of piling in on overpriced assets and missing out on great companies on sale.
We talked about this, especially in the behavioral financial mistakes that a lot of investors make, that you and I have talked about that. I think we usually go through that annually just to remind people. And this is just a perfect example because of these predictions that people are going to buy high, sell low, right? Because they're going to follow the trend.
Well, again, that's why you need a buy discipline and sell discipline. I'll give you a great example. I'm not going to mention the stock's name, but we bought a stock at an average price of about $28 a share in probably late November, early December. And some news came out, some information came out, and this stock basically went from $28 a share to $62 a share in about 3 weeks. And I sold back to the target. I used my sell discipline and took profit off the table when it was at 58. So almost at 62, only to see it today trading back down to 30. Actually, even got down to $23 yesterday, back to 30. So here my clients in 30 days had a position they bought at basically where it's at now, but doubled its money in 3 weeks. So basically the core position now is free money, for lack of a better phrase, because we took the cash off the table. That's having a buy discipline and sell discipline. And to be frank, we were just lucky. It was just, right time, right place. Right. The long-term fundamentals haven't changed, but momentum will do that. And to your point, investors will pile into momentum only to find themselves becoming emotional and selling it at a loss, which I'm sure a lot of people did when it went from 62 back to 23. We, of course, did not sell down that low.
Hmm.
Prediction number 2 for 2021, Uncle Matt. Investors, ironically, investors will continue to see company stock prices as well as, quote, the stock market move up and down irrationally, as usual. Remember, though, Uncle Matt, you don't invest in the stock market. You invest in businesses purchased through a stock market. We've always said you don't invest in the stock market. It's just the greatest place to go buy and sell businesses.
I was talking to a friend of mine over the internet, and we were talking about individual stock purchases, and she said, no, I'm more of a mutual fund girl because I just can't imagine the risk of owning one company. And you know what I did, dude? I actually sent her the link to the podcast. I was like, you got to check this out, because you know what, you've just been you haven't been educated correctly, right? Because that's
Correct.
all you're doing in those is buying crap tons of individual companies,
Right.
but you think that you're what is that called? I'm lost the word.
Over-diversified.
There, thank you, sir. Thank you.
Yeah, and it's inefficient. It's inefficient investing. Why do you want to invest in a bunch of companies that you have no idea how well they're going to do? It just for the purposes of diversifying, and that's why we have a structured buy discipline, sell discipline, and we have a structured asset allocation strategy. And it's interesting, some of the old school advisors, and I had an issue with one of my old advisors I used to work with on this, their idea of appropriate asset allocation is X amount in stock, X amount in bonds, X amount of cash based on their investment objectives. And my response to that is, that's too cookie cutter, and that's not common sense, because why would you want to own bonds right now when interest rates are at historical lows? And most investors don't realize the risk associated with bonds. But this is the mentality of financial advisors. Financial advisors, most of them, I'm saying this in general, this is not to everybody, so please don't send me hate mail. Advisors in general are not money managers.
Right.
They're asset allocators. And the difference is when you have advisors like you do at Nepsis who work for a firm that actually manages the money, there's a greater level of transparency. There's a greater level of understanding exactly what's going on in a client's portfolio and why. And that's why our clients don't get worked up over volatility. We've done the job up front of determining how much volatility they can handle, putting them in the appropriate models, and then managing it. And these clients, like during COVID, when the S&P went down 35% in the blink of an eye, clients were looking at their accounts going down. But you know what else they were looking at? They were looking at the companies they were buying on sale.
That's right.
I literally had one advisor had a client email and said, tell Mark to quit making us so much money. Because, we bought Square, started the year at 68, went to 30 or 35. We bought it like 33, 34. And in a blink of an eye was back in the 60s, now trading at 2.25 at an all-time high, in less than a year.
Yeah.
And you've heard me say it a billion times, volatility is not risk. Not knowing what you own and why you own it is far greater risk, in our opinion.
All right. Number three. Now, number three, I'm going to kind of set this up just because the other ones I didn't feel I even had the ability to. But this one is one that drives me absolutely insane. And I think the outcome, if these people did this and took the money off the sidelines, oh my goodness.
Let me read the prediction, and then I'll give you an exact example of that. Investors will continue to attempt to time the market and fail, as there are approximately $16 trillion held in U.S. households waiting on the sidelines, thus missing one of the best years for stocks since the Great Recession. The S&P, I think, was up 16% last year, give or take, somewhere in that neighborhood. I'll give you a classic example. We have a client and it was the only client that did this without consulting, took their individual account, not their IRA, their individual account, and took half of it and went to cash, which means they paid tax on the gains they had. They did this back in October before the election. Okay. So they had a lot of gains, paid tax on the gains, put $500,000 in cash, 50% of their portfolio. And of course, in November and December combined, our average client in that investment category was up 20%. So half of that model's return happened in November and December. So balanced portfolios on average did 35 to 40% last year. And that's, by the way, that's just an estimate. Everyone's a little bit different because we're an SMA. You got to give that disclosure. But my point is, and also past performance is not indicative of future performance. Have I given all the disclosures now, Matt? And they put $500,000 into cash, missing out on 50% of the gain for the rest of the year in 2 months.
Wow.
This is why you cannot time it. Only to have them in late December say, go ahead and put half of that cash back in. Oof. So not only did they miss the gains, they paid tax on what they had. They got a double whammy. I'm kind of disappointed because, we preach this all the time. It's time in an investment, not timing. You can't time companies. You can't time the market, but more importantly, you can't time businesses. You've got to stick to process before progress. And there's a legit example, dude, of some serious tax paying right there and performance. So there you have it, huh?
Well, if the 16 trillion was actually put into the market, could you imagine?
Yeah.
I mean, that's a lot of money, dude.
We tell me about it. We don't actually do predictions on what we think the S&P 500 is going to do on an annual basis. We are constructive on the economy. We do think there's going to be a lot of pent-up demand in 2021 as COVID unravels. But the fact of the matter is that the greatest time to buy, as usual, was when everybody was selling at the end of March and April. Yeah. And that's how it is every time. One of my favorite quotes from the late, great Shelby Davis: investors make most of their money in bear markets. They just don't realize it at the time. Mm-hmm. They make the most money in bear markets. They just don't realize it at the time. I think that's a great, great quote.
Yeah. All right. Number 4.
All right. Number 4, investors will continue to focus on short-term or historical performance, which will distract them from focusing on their financial plan and making intelligent long-term investment decisions, i.e. that person who went to cash. By the way, I love it when people say these aren't predictions. These are actually things that people do. Oh, really? Did someone just have an aha moment? Duh. I actually had an email from a guy who said that to me. I said, thanks a lot, Captain Obvious. Yeah. That's why we do this. Again, same thing. Investors trying to focus on short-term performance as opposed to historical performance. Of course, historically speaking, past performance is not indicative of future performance, which is exactly why I don't answer questions from investors who say, well, how'd you do the last 10 years? It's the wrong question to ask. Yeah. The actual literally best question to ask is, what's your client turnover?
Ooh, that is a great question.
Yeah. Because that is more indicative of whether or not your clients are happy or not. Yeah. And of course, I can still say it, knock on this plastic table, whatever it is, but knock on wood. I still have my very first client I got in 1995.
Man, that person got to be old as dirt.
Actually, they're not that old. They're in their early 70s. But they did say to me one time several years ago that they can't believe how much money they have and wanted to thank me. And I said, don't thank me. You guys just listen to what I told you to do. Mm-hmm. And they just stuck to the knitting, as we like to say, stick to the knitting. Mm-hmm. I got to love it. I love this business. That's why I'll never retire.
Yeah, we just so everybody knows, Mark and I were talking about his imminent retirement at some point, and he's like, "No, dude, why would I ever do that? This is too much fun." And you know what? That's really that's why if you get up in the morning and you don't feel like you're working, Boy, that's a heck of a life.
Yeah, I haven't for years.
Yeah.
And, look, if I've got to manage my own money, why wouldn't I manage others' money?
Yeah, I'm right there with you, dude. All right, one of the things that you say, about number 4, and this will lead us into number 5 is how long people generally used to hold their investments compared to today. Right?
Yeah.
It used to be, it used to be 8 years, and now it's 8 months, and
Yes.
that's because of what happens here in number 5.
Yeah. So number 5, investors will continue to allow their emotions to get the best of them and make investment decisions emotionally as opposed to fundamentally. That guy who put $500,000 in the cash, it was an emotional decision. There was no fundamental basis for that as a long-term investor. And it's very true. People become emotional. And I think, look, with the advent of Robinhood, with the advent of online trading over the last, 20 years or so with Schwab and TD Ameritrade and E-Trade and all of them that have come up since then, access to information is a lot quicker. Information news. I used to hear the stories of back in the olden days that when a piece of news came out from a company, it would take weeks to get disseminated out to the investors. Now it's in a matter of minutes, right? So markets have inherently become more volatile. While many investors find that, maybe to be disheartening and a problem, I actually find it to be absolutely awesome, excellent, because volatility does create that opportunity. I'll give you a great example. We own this stock, which again, I will not mention. We started buying at 42, went down into the mid 30s, like 36, 37. And today, about 3 weeks later, literally we started buying this one in November or December also. Stock last trade was at $64 a share. 64. So, and that's all in the last 30 days, Matt. So some stocks inherently are just more volatile, but volatility is what creates the opportunity for successful investing. That's why we have literally written in our investment policy statement, you have to base the performance on your portfolio. If you're a long-term investor, like in a growth or growth and income portfolio, you have to base it on a 7 to 10 year time frame, right? Not a 1, 2, or 3 year time frame. I mean, take a look at JD.com. Here's a company, Matt, that went from $19, $20 a share when we started buying it 3 years ago. 3 years, okay? Goes up into the 30s, mid 30s, maybe up to 40. I can't remember in that time frame. Goes all the way back down to 19, $20 a share in 2018. Today, last trade, 95.
Now, I want you to put a pin in this so that we can talk about this at a later time. But I want to talk about doing so if you're at 95 and like you've done with some of the other stocks that you've already talked about today, is to get back to your not benchmarks. What did you call them?
Target. Model target. So each position in our portfolios, depending on tolerance for volatility, i.e. risk, investment objectives is the best way to put it. Depending on if your growth or your growth and income, balanced income and growth or income, all five, those are our 5 options. The percentage of each position you will own will vary based on that. And there's a target in the model. So the computers that we use, our software, we have a target percentage that we want to own. And we don't do like a lot of advisors do who like to rebalance, quote unquote, their portfolios at the end of each month or the end of each quarter. They take these buckets and they rebalance. I'm sorry, to me, that's not investing. That's just inefficient. You can have a computer do that. Why pay someone to do that, right? We will let positions run. Part of the reason why we had such a great year last year, we had a lot of stocks that ran big time. Baidu, which we've owned for 14 years, actually. Baidu went from $130 a share to $220 a share in about 30 days. And bounced from 90 to 140 for about 2 years. Actually, that's not true. Maybe a year and a half. My point is that stock prices in general, it's not always the case, but in general, I really think that the majority of returns that come out of a stock happen in very short periods of time.
Yeah.
Which is why you can't time a stock. You have to understand what you own and why you own it, understand how it impacts your overall portfolio. Because as you know, Matt, in our investment policy statement, we also state that no one position should make or break your portfolio's performance. Every position is owned for a particular reason for an overall asset allocation strategy, which, our largest position has been our worst performing position, which is Zest. And that's, I can say it because it's public information. And our portfolios have still done extremely well relative to any benchmark you want to use.
I just think it'd be fun to dive into some of those secret saucy type triggers that that you and Chuck and the investment team chat about when you guys meet regularly about making sure that you're hitting those targets. But we're not going to talk about that today. I want you to put a pin in that. We'll talk about that later. We're on what, number 6?
Investors will continue to be scared by stock market volatility and in turn create great buying opportunities. Like always, yes, we absolutely took advantage, as you know, of the massive pandemic pullback and volatility. We got so many stories of companies. I could go on for an hour about, stocks that we tax loss harvested on and actually literally went back and bought back at much lower prices, even after we got the tax loss harvest on it, only to see the stocks more than double from when we bought it back. It gets back to the 4 keys to successful investing: the investment philosophy, the strategy, flexibility, and transparency. And those 4 cornerstones are coincide with your buy discipline and your sell discipline that allows Nepsis to literally take advantage of not only macro volatility. What I mean by that is a pullback of the overall quote unquote market. In other words, stocks in general going down, but more importantly, individual stories. I told you about the company that doubled in, 30 days, and we sold basically, back to target, which was pretty much half the position, and then went back and bought it back, here where we started buying it 45 days ago. Yeah. So that's the power of that flexibility. And while people worry about volatility, Matt, simply because they don't know what they own and they don't know why they own it.
Well, and I was going to chime in on this too, because it's the doom and gloom scare media on CNBC, on Fox Business, on Yahoo. I mean, goodness gracious. It's like, I remember a friend of mine said, oh my God, the Dow Jones Industrial Average is down 3,000 points. I'm like, that's it? And do you even know what that means? I mean, what is that, 1%?
Yeah.
Right. I was just like, dude, seriously. Come on, you're contributing to the fear mongering, and it drives me nuts.
Yeah, it's interesting. You bring up an interesting point. I really should bring Chuck on one of my podcasts. We haven't done that for a long time. Chuck does paid research for outside advisors, and he is absolutely amazed at the conversations he has to have with these advisors who are constantly in panic mode during this whole last year. And it's because they are cookie cutter. They are modern portfolio theory investors, and they don't know what they own. They don't know, generally they know why they own something, but they don't know specifically why. And they get caught up in the fear mongering. Yeah. And I love it when people are fearful, because this is going to sound so trite, but it's true. I was literally sitting in my family room with a couple of my advisors during March and April, during the pandemic, while the TV was on in fear and gloom. And I was literally spending 4 to 5 hours a day in buying companies and positioning portfolios, tax loss harvesting, repositioning. Because remember, I shouldn't say most important, there's a lot of important factors. When we make a decision to invest in a company, Matt, we're looking at that decision as a 3, 5, 10-year investment, not 6 months. So if we're wrong on when we buy it and it goes down, we'll buy more. And if the long-term fundamentals haven't changed. Yeah. And that's the greatest story of Zest, is that, we literally reduced our basis by 45%. And it's paid off for a lot of our investors, and it will continue to pay off. Yeah. We hope, we think. Obviously, I can't guarantee that.
No,
all right.
No guarantee.
We never can't guarantee anything. No. Number 7, investors will continue to focus on inaccurate portfolio comparisons, with benchmarks focusing on fees and short-term performance versus the investment process. This, of course, as you know, is a symptom of someone who does not invest with clarity. Right. People focus on historical performance. Here's what I always like to ask somebody. Why are you asking me about historical performance? Well, I want to see how you've done. And my response to that is, well, let me ask you this. If you don't know how I achieved the returns I did, why would you ask me? Because you have no idea what we did to achieve those returns. Mm-hmm. And that does not mean that those returns are going to come in the future. Without giving our returns away for our growth portfolios in 2020, or did we talk about that last podcast? I can't remember. I don't know that we'll have a year for a long time. The last time we had the performance that we had in 2020 was in 2009. Oh. It was 11 years ago. Yeah. But that's precisely why you have to be a long-term thinker. And you have to invest in the process longer term. And that's why you cannot focus on benchmarks. Now, fees. I used to always use this analogy, Matt. If I told you when you asked me, well, what are your fees? And I said, my fees are 50% a year. And they would say, you're charging me 50% per year? Well, how can I ever invest in that? And then I say, well, our average rate of return per year is about 150%. Would you pay me 50% if I netted you 100% gain every year?
Well, now,
netted?
Of course, I would. But you're talking about mathematical logic there, which a lot of people don't seem to really get. So
that's my point. Yeah, in other words, fees are relative. In general, our opinion is you get what you pay for. Yeah. You want to pay 0.006% on an index fund? By golly, go right ahead, because that's exactly what you're going to get. Yeah. All right. Number 8. We're almost done, Biggie. We're almost done with the top 10. By the way, just to tease people a little bit, 11 through 20 are way better, which, of course, they're going to have to come back to the next podcast.
They are. Yes, absolutely. Have to tune in.
Inevitably, there are people listening to this podcast that are probably going to go, these are the dumbest predictions I've ever heard. But you know what? They're predictions. They're also maybe what you would refer to as a truism.
Why if predictions are true, why is that a bad thing? I don't understand that.
Hence the reason why we haven't been wrong yet, Biggie.
All right, next one.
Here we go. Number 8, investors will continue to be over-diversified in their portfolios and will not be properly asset allocated, leaving their portfolios inefficient. This is a very important thing. I remember back in 1999, 2000, when the markets had the big pullback, when we hit the peak in March of 2000, and we had the big pullback over the next couple of years, of course, exaggerated by 9/11. But I can remember so many investors saying, I thought I was diversified. I own these mutual funds. I thought I was diversified. And my response to them was, yeah, you were diversified, but you weren't asset allocated. And this goes back to the COVID correction, and investors would say to me, if you're how much cash did you have when COVID hit? Let's just use our growth portfolios as an example, because there's always a little bit of cash and balance and income type portfolios. There's always some cash. But anyway, in the growth portfolios, we're always fully invested for the most part because it's long-term and it's growth, right? And people would say, well, how did you take advantage of the COVID crash if you were fully invested? Thank you for asking a great question, because we were appropriately asset allocated. In other words, not everything goes down the same when things go down. And it's that flexibility that allows you to maneuver and adjust on the fly.
I remember that was the first question I ever asked you that I thought I stumped you. Seriously, it was like 2 years ago. You were talking about this, and we, and again, I was still learning the difference between, what real diversification is and what real asset allocation is. And, I was feeling all smart, and boy, that didn't last long, but I'm much smarter now, which I'm very, very grateful for. And that's something else, Mark, that I think we should probably review again. Every once in a while, I think we need to have that discussion. I think we need to talk about volatility and risk. And I think we need to talk about asset allocation versus diversification. All right. What are we at, number 9?
Number 9, Biggie.
Okay.
Investors will continue to follow the headlines instead of the bottom line when making investment decisions. Just look at all of the 2020 headlines that predicted doom and peril. Mm-hmm. Oh, by the way, the S&P ended the year up 16%. I think the NASDAQ, don't quote me on this, but I want to say the NASDAQ was up around 40% last year. I could be wrong.
Wow.
I believe that was the case. And I think if people heard that, most people would probably be surprised that even the S&P 500 was really up that much, because, look, at the end of the day, the fact of the matter is that is what happened. And I really think that investors who focus on that doom and gloom, right, missed out on a tremendous opportunity to take advantage of not only, Matt, taking advantage of that volatility, but from a long-term standpoint, because remember, you're positioning your portfolio when you buy things, right? You are positioning your portfolio for the next 3 to 5 years. At least that's the mentality you should have. And investors don't focus on that. And that's where they end up getting hammered. And that's why when you think about this, the S&P 500 up 16%, the average is what, 9.5 now per year. So in other words, the S&P was up above the averages.
Yeah. After the world was coming to an end.
I think that is how you have to assess your investment portfolio. So there you have it.
Let's end with 10 here, and then get ready for our next podcast, which is going to be 11 through 20.
You got it. Investors will continue to have unrealistic time horizons for their investments. Funny. I think we just discussed that, didn't we? Mm-hmm. Focusing more on short-term pain versus long-term gain. As we like to think, Biggie, the tragedy of a short-term thinker. And there you have it.
There's the 10.
There is the top 10.
All right. So what we're going to do is we're going to, the next podcast is going to wrap up the Roaring 20s 20 predictions. Mark is doubling down on the amount of predictions that he's doing. And we're going to dive into some that you seem to think are even more fantastic than the first top 10.
We're going to have some new predictions, boss.
If you want to find out what's going on a regular basis, please make sure you go to investwithclarity.com and check out the blog. Obviously, you're listening to the podcast, and of course, sharing the podcast would be smart with your friends and family so that they can achieve their clarity, which is really, really important. But if you want to see some of the stuff, they come out with blogs all the time, everybody, and they're wonderful. They're easy to read. They're in like normal people language. They're not super highly technical, and there are other great things where you can I don't know, sound like the smartest person at the cocktail party, because you've got clarity and you've got the confidence and you understand what flexibility and transparency is. All right, Mark, got anything else, brother, before we wrap up?
I don't. You
All right.
wrapped up well.
Thank you. Well, make sure you subscribe to the podcast and make sure that you give a review on the podcast, because that would be super duper. A good 5 stars on iTunes would be magnificent. And we will see you very, very soon. Thank you very much.
The content discussed is for informational purposes only. It is not a solicitation or recommendation for any securities that may be mentioned herein. Advisory services offered through Nepsis Inc., an SEC registered investment advisor.